All right, let's talk about one of the most exciting and frankly chaotic times in the financial world, earnings season. It's the period that can make the stock market feel like a total roller coaster.
You've seen it, right? A stock just takes a nosedive, or maybe it shoots to the moon, and you're left wondering, what on earth just happened? Well, a lot of the time, it's not random at all, and today we're going to unpack exactly why. So, what's behind all that drama? Well, it all comes down to what you could call the market's big report card day. And that, my friends, is what we call earnings season. So, what is it exactly? Well, it's pretty simple, really. It's this specific time, 4 times a year, when all the big public companies have to, open up their books for everyone to see. They release these super detailed financial results. Basically, they're report cards telling everybody, from Wall Street pros to regular folks, exactly how they did over the last 3 months. And listen, this isn't just some random thing that happens. It's got a predictable rhythm, like clockwork. You've got April, when they report on the first quarter, then July for the second, October for the third, and January wraps up the year. It's a cycle that investors have circled in bright red on their calendars, for sure. Okay, so the company drops its report card, but what's actually in it? What are the grades we should be looking for? Let's pop the hood and decode what really matters in these reports.
All right, there are usually three big numbers that everyone zooms in on right away. First up, you've got revenue. Think of this as the total amount of cash coming in the door from sales. Then there's profits. That's what's left over after you pay all the bills. And finally, the one that often makes the biggest waves, earnings per share, or what everyone calls EPS. Now, all three of those are super important, but let's really drill down on EPS for a second. In the investing world, earnings per share is often seen as the final grade, the real bottom line. And why is that? Well, because it neatly boils down a company's entire profitability into one single number that you can easily compare.
Okay, and this is where it gets really interesting. The market's crazy reactions, they're not just about whether a company made a lot of money or not. Nope, it's all about how those numbers stack up against what everyone expected them to be. This whole expectations game creates two very clear but very powerful results. A company either beats expectations, meaning they did even better than the analysts predicted, or they miss expectations, which means they fell short. And that simple little comparison, that's the trigger for almost all the chaos you see. And the reaction is, it's often instant. If a company misses even just by a little, its stock can get hammered. But if it beats, whoosh, the price can skyrocket. It's this gap, this space between what was expected and what actually happened that fuels those huge, dramatic swings in the market. So we get the mechanics, right? Expectations versus reality. But why does this whole quarterly song and dance matter so much? And maybe more to the point, why should you care? Think about it like this. Earnings season is your chance, 4 times a year, to really look under the hood of a company and see how the engine's running. It's a moment of pure transparency, a real health check that goes way beyond the day-to-day headlines. So during this period, what are the smart investors looking for? They're really asking two big questions. First, how are the fundamentals? Is the core business strong and healthy? And second, what do these numbers tell us about future growth? Is this a company that's built to win in the long run? With stocks jumping all over the place, it's so easy to get caught up in the hype and make an emotional decision. So for this last part, let's talk strategy. How do you actually navigate all this volatility without losing your mind? Right, so that's the million-dollar question, isn't it? How do you tune out all that noise? How do you stop the short-term drama from completely wrecking your long-term plans? The answer really is to have a long-term approach. It's about looking past the flashy headlines and really assessing the true health of the business. It means you're focusing on where the company is going, not just where it's been for the last 3 months. And maybe most importantly, you have to remember that one quarterly report is just a single snapshot in time. It is not the whole movie. It all boils down to this simple idea. Having a clear strategy and keeping that long-term perspective, that's your absolute best defense against making a rash, emotional decision when the market starts swinging. And that really brings us to our final thought. Earnings season is all about short-term reactions. The real challenge, but also the real opportunity, is to see right through all that noise. So I'll leave you with this. In a world that's obsessed with the next 5 minutes, where are you going to find long-term value?